Guys, when it comes to financial reporting, one thing that students truly fear is, accounting for taxes, and specifically when they reach the deferred tax assets or liabilities part. Now, any sort of financial reporting you ever learn, it could be ACCA, so right from financial reporting to strategic business reporting. It could be CMA, where you have your external financial reporting decisions, or even CFA, you will learn about deferred tax assets and liabilities. Now, the reason a lot of students find this concept extremely daunting is because of all the jargons involved with this concept. But at Zell, we believe that this is an extremely logical concept, one that is fairly easy to explain. And the sums associated with this, while we will not be solving a sum in this video, the sums associated with this particular concept also become easy to solve if you have your basics right. So in today's video, I will not use any jargons. I will not use any terminologies that you might find confusing to understand. We'll just talk straight logic. Now, what essentially gives rise to a deferred tax asset or liabilities is discrepancies. Now, when it comes to discrepancies, just think of it very, very logically, right? If you pay more than you needed to in this year, that means you'll pay less in the next year. That's essentially how tax works. Then that becomes a deferred tax asset for you. However, if you've paid less this year and you have to pay more next year, that will become a deferred tax liability for you. Great. You've understood the basic premise of the concept. But what most videos or what most professors will not teach you, they will only teach you how to solve the sums. What they will not teach you is what gives rise to these deferred tax assets and liabilities in the first place. If you think like me, your first question was, okay, Rushil, great, we understand that if you pay more expense, less expense, this happens, that happens. But why? Why does this happen? Don't we have a standardized way of doing this? In fact, we do. But what usually happens, guys, is that the tax rates and the tax rules that are applicable are generally different accounting standards. So when it comes to US GAAP or IFRS, the prescribed rates are different as compared to the tax collection bodies. So in India, you have the income tax department. In the US, you have IRS. Their rules and accounting standards rule, they don't match. I'll give you all some examples as to why these things happen. But before I do that, I also want to talk to you all about two types of differences that happen. One is a permanent difference. One is temporary difference. Let's talk a little bit about these two types of differences first, and then let's, finally close this video. So I talked about, temporary differences and permanent differences. Amazing. So guys, as the name already suggests, permanent differences are things that will not reverse in the future. Again, confusing, right? So let me explain to you. Let me take an example for you here. You know how in India, when you donate to certain charities, the government will essentially say, okay, claim a double tax deduction on this. Now, essentially what is happening here is when you're computing your tax as per the Indian Income Tax Department, you're claiming that deduction. But is that deduction applicable in your financial statements? The answer is no. And this will result in a permanent difference that will never reverse. So this essentially will not give rise to a deferred tax asset or liability. This is just a difference in a permanent difference, rather, to use the right terminology, in your accounting standards and in your taxation standards. Next, when we talk about temporary differences, now these differences are what give rise to a deferred tax asset or liability, because they are the reason why you're, incurring more expense on taxes or saving on taxes. But just remember, from an exam perspective, that these will reverse at some point in the future. Classic example of temporary difference is depreciation. Now, again, not to make it too complicated for you all, but let's say that you have to depreciate as per, so there are different standards for depreciation, by the way, for all of you all that don't know. But as per accounting standards, let's say you have to depreciate an asset by 30%. But as per IRS or income tax standards, you have to depreciate it by 20%. What do you think will happen? Well, if you do the computation, you will realize that ultimately the amount will work out to the same thing over, the life of the asset, but it will reverse at some point in the future. So you're either going to incur more tax right now and pay less tax later, when you compare the two numbers, or you're going to pay less tax right now and pay more later. And this essentially gives rise to deferred tax assets and liabilities. If you want us to solve a sum on this particular concept, do let us know in the comments below. And I hope that this has been helpful and not too confusing for you all to understand.